For Morningstar, I'm Jeremy Glazer. The U.S. economy added 242,000 jobs last month, well above expectations. Bob Johnson is traveling, but I'm here with Roland Trinowski to give us his take. Roland, thanks for joining me.
Great to be here.
So let's start with this data. The headline looks pretty good at 242, but maybe some questions about wage growth. What's your overall take on this report?
Yeah, I think overall this was a good report that exceeded most expectations. As you said, we had 242,000 jobs added. The consensus only called for about 190,000, and our own expectation was about 210,000. So that was definitely a positive surprise. The previous month was revised up by nearly 20,000, so that was also a big plus. The unemployment rate remained at 4.9%, so that was unchanged. And as you mentioned, what was not so good about this report was the decline in hourly wages and the weekly hours worked. But I think it's important to underline that those numbers tend to be really volatile on a monthly basis. So maybe the importance of it is not as high as as the market seems to be placing right now.
When you look at the different sectors, were you surprised by the makeup of these job increases, or more of a similar story than we've seen?
I think more of the same, really. If you look at the category breakdown, we've seen strong categories leading by healthcare, 57,000 jobs added, retail trade, 55,000, followed by education and business, professional business services. So all of these categories, with exception to the retail trade, are actually relatively high-paying jobs. So I would say that the makeup of the report was relatively high quality. When it comes to the retail trade, I think it's important to mention that on a non-seasonally adjusted basis, retail has actually lost jobs. So the 55,000 gain that we see is actually just a seasonal factor added back. And so in other words, we essentially didn't lay off as many retail trade workers as the seasonal factor would have anticipated. On the not-so-good side, we have majority of the weakness, again, concentrated in the goods-producing and manufacturing side. So we had mining losing 18,000 jobs, and durable goods manufacturing losing 12,000. So I think it's more of the same, where we see the job weakness being concentrated mostly on the goods-producing side, and the services economy is doing much better and is outpacing the rest of the economy as far as the job growth.
We had a decline in temporary workers. I know there's some who say that maybe is a sign that employers are kind of tightening their belts a little bit. Does that concern you at all?
No, it doesn't necessarily concern me based on this single month reading. The reason I say that is because we just had a January report last month, and what happens typically in January, we lose a lot of jobs in the temp category. That's just something that's very seasonal and happens every year. And sometimes the spillover from January can extend into February. And the seasonal factor in February is not strong enough to correct for that. So I would be really careful when looking at the temp, especially early in the year where we typically lose more jobs than we add.
So you mentioned that jobs are added in some higher paying sectors, but that didn't show up in the wage data, didn't show up in hours worked. Why do you think that number stepped back?
Yeah, that's a very good question. I think it's a very difficult one to answer. Overall, the hourly data, the hourly wage growth data was down 3 cents on a monthly basis, or 0.1%, and the hourly wage growth was down 0.6%. So this is not the greatest news, but at the same time, I would say this is not necessarily a reason to worry. We've seen the wage data be really, historically has been really volatile on a monthly basis, and those monthly swings tend to often reverse themselves in the following months. So I think before we really draw any conclusions and try to come up with any particular reasons why the reading this month was so weak, I think it's probably well advised to maybe see whether the weakness in the wage growth and the hours will be persistent going into the next month. Because as I said, we can very easily see those declines completely reverse themselves in March.
So we have a pretty good headline number that was near the level where we had said earlier that might kind of force the Fed to move maybe a little bit earlier than people were expecting. How do you think this impacts central bank policy? Is a March increase on the table, or are we looking more the June or later in the month? Or later in the year, excuse me.
Yeah, I think this report has some implications for the Fed. And I think overall this was a good report. We've seen higher than expected job growth. But what we did not see was the increase in wages, and what we did not see was the further decline in the unemployment rate. So I think had we seen all three of those elements present in today's report, the probability of a March hike would have been much higher. Given that we only see one out of the three, which was the job growth, I think that the probability of a rate hike in March remains somewhat unlikely. The markets are currently pricing the probability for March at less than 5%. So I think the markets have decided that the March is off the table. I tend to agree that this would have been really unlikely for the Fed to act now, especially given this wage data in today's report. With that being said, I think that the markets are somewhat underestimating the overall probability of the rate hikes this year. Based on the futures data, the markets seem to be predicting that there won't be another rate hike until late in 2016. And I think that's not necessarily, in our opinion, that's not necessarily the most likely scenario because given the recent uptick in the core inflation that we've seen recently and the Fed's concern with inflation, I think, in the absence of a major disasters and just the continuation of more of the same economic data, and maybe some help from the improved wages, the rate hike within the next 3 to 6 months is somewhat likely, definitely more likely than the market seems to be suggesting. So I think it's important to reaffirm that the Fed is probably will be committing to their continuation of their policy, and counting on just one hike late in the year is maybe a little bit too optimistic.
Roland, thanks for your analysis today.
Thank you.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.